All right, ladies and gentlemen, welcome to a Thursday edition of the MSP Initiative Live. We are T-minus a handful of days before our team shows up down in sunny Orlando, Florida, for what should be an interesting week, starting with Zero Trust World, which is going to be right across the street from where you've seen IT Nation for the last several years. Uh-oh. Uh-oh. I'm back. I made it. Okay. Let's try it again. I thought I killed my computer, but power cord saved me. Sorry about that, everyone. So let's try that again. We're going to be down in Florida next week. I'm going to share my screen real quick, just to take care of some quick housekeeping items. Here we go. So Zero Trust World. You can still go to this, by the way. zerotrustworld.threatlocker.com. I think they have registration down to $99. Somebody told me. But check this out. So at Zero Trust World on the first night, which is Monday, this upcoming Monday, we will be running another MSP community block party. So if you're actually in the greater Florida area and you can make the conference, please come. If you can, hang out with us at night. All of your favorite vendors and peers from the greater MSP industry will be there, and we'd love to see you. So if you're an MSP, go ahead and put in, register at the bottom, and we will make sure you get into that party. So definitely check that out. This session and every other session is available after it's done being recorded in podcast and video format under the sessions tab of mspinitiative.com. And lastly, we have 8 one-week Channel Strong bus tours coming at you this year. And you can find that under the Channel Strong tab. You can see where we're going. We're still looking for MSPs to host us in a lot of these cities. And obviously would love to invite you if you are along the path of any of these bus tours. So you can find that under mspinitiative.com under Channel Strong. Okay, now that all the housekeeping is done, we are welcoming back to the show. It's been a little bit of time, but always a good time. Mr. Reed Warren, who is now at IT Valuations. I'm going to give Reed a little bit of a chance to give a little bit of background about himself if you've never met him or heard about him before, and what his company does. And then we're going to get into talking shop about, the ebb and flow, I call it, of what's happening out in MSP land when it comes to people who are looking to get together with other MSPs and make bigger companies, maybe sell, maybe buy. I mean, combination of all three. Never a dull moment. I'm actually surprised Reed has hair, because I don't. I would have pulled it out a long time ago if I was doing what he did.
Well, I've decided, George, if it starts receding too much, I'm just going to do exactly what you. I want to look like you. I want to be like George, and I'll just shave it off, whatever's left. So, no,
keep it as long as you can, man.
Yeah, it's been a while. I mean, it's been about 4 years ago since we were last on. So I won't hold that against you.
No, that's okay. I mean, MSP Initiative is not even 4 years old, but we did have you on a series with my other company, BVoIP, right?
Yep.
But either way, right? And by the way, that's all recorded. That was a great series. We had Arlen Sorensen, previously of HTG, now IT Nation of All. We had
Jameson West,
who has since come out with a book about the emotional side of selling a small business. He talks a lot about that in that whole series we ran back in, was it 2018, 2019? So it's been some time.
Well, and it's a good book, and it's a good segue into this conversation as we get into it. So just really quickly for everybody on IT Valuations, we do what's in our name. We do valuations. Really on every project that we do. All of our work happens for IT services firms in North America. We probably we consider ourselves virtually Canadian because I'm in Minneapolis, Minnesota. We're north of Toronto. So for all of our good friends up in Canada, we do quite a bit of work up in Canada as well. But in the end, I would say in a typical year, we do 80 to 100 valuations. of IT services firms. So that's a big chunk of our business. When we do a valuation, we don't want it to be just a number. We want it to be able to translate information to you on, hey, what does this mean in the context of a transaction, and how do we drive value? So one of the things we do in valuation world is, hey, we got to look at company specific risk, or what are those elements that aren't perfect about your company, because we have to be able to wrap our arms around that from a value perspective. But now that we've done that, we can actually determine, hey, what you could be worth if you fix these kinds of things within the business. And so we end up doing a fair amount of consulting around what we call value creation, which is really being able to help you optimize the value of your business for some sort of exit and exit planning. And then about a third of our work, typically 3, maybe 5 mergers a year, and that's where we're going to get, 2 different companies, 2 or 3, because we're doing some 3-way mergers as well, and we'll do valuations on each of those companies. We'll look at what the converged value would be of the entity. Typically, we're seeing somewhere between about a 15 and about a 25% increase in value by merging. And then we have a whole process for being able to facilitate the creation of the new entity. And there's a lot of tax advantages for it. Don't know that we'll get into those today, but can certainly talk about those if anybody's interested in that. And then building out the new operating agreement, buy-sell agreement, call put rights put into it, drag along, tag along, all the stuff that goes with that. And then about a third of our work is transaction work. So somewhere between really about 4 and about, on the high side, maybe 8 transactions a year that we get to be a part of, and that we facilitate both buy side and sell side representation. And that's probably where we've seen one of the biggest swings in the marketplace from last year coming into this year. Last year was so hard to find a seller, and I think a lot of the reason for that, we thought it was a shortage. I'm actually becoming convinced it's less of a shortage and more of just a reality that, hey, 2020, people saw a dip in their trajectory as a result of COVID. 2021 was a very, very strong year for the MSP market, and a lot of people coming through 2021 saying, hey, my numbers look good now let's talk about selling. And so we've seen a massive influx just at IT valuations from a valuation perspective and a sell side representation perspective of companies coming at the market and say, okay, my numbers are good enough now that I'm really willing to take myself to market and possibly sell the business. And so anticipating a pretty aggressive year, I think, from a velocity perspective in the transaction space.
All right, so let's rewind.
Yes.
Why do people, and this is maybe a harder question because it's non-scientific, but why do people always think their businesses are worth more than they actually are?
Why?
Yes, why?
So it's kind of a joke. I say joke in a fun way. So when we do valuations, it's probably 1 or 2 in 100. When they get the valuation, they go, oh my gosh, it's worth more than I thought it was. Because everybody thinks themselves, and nothing wrong with it, but everybody thinks themselves above average, right? If you're a CEO, you've been running your company, you've been 20 years, building the business, and nobody who wants to say I'm average, right? And so the reality is everybody kind of views themselves above average, and there's a lot of data in the marketplace, and I love what Paul Dipple's done, but one of the things that we run into quite a bit is, he has, well, if you're 15% EBITDA, you can get an 8.2x multiple on your business, and I go, well, that's true, but that's true only if you have at least $3 million in EBITDA, right? If you don't have $3 million in EBITDA, you're probably not going to get an 8x multiple, right? And so there is a lot of misunderstanding, I think, in the marketplace, in the fact, even on the analysis stuff that we do, everybody talks about multiples, but multiples are actually derived. They're not applied. So in other words, buyers don't come to the market and say, well, I'm going to pay 8x on trailing 12 months EBITDA, and I'm just going to buy everybody I can. No, buyers don't come at it that way. They're going to look at your financial performance. They're going to look at history. They're going to look at your growth trajectory. They're going to look at how different you are. They're going to look at how tied the business is to you. There's a lot of factors that go into determining value from a valuation perspective, but also from a transaction perspective. And what ends up happening is you end up getting a transaction value. And so then they take your transaction value divided by your EBITDA, and that becomes the multiple. But if you just did the math and said, well, okay, I sold my business for $5 million, sold my business for, let's just say $2 million, right? And I'm a $4 million MSP, and I've got, a $200,000 EBITDA. well, okay, that's 10% EBITDA. You know, I just got, well, if you sold for $2 million, you got a 10x multiple, right? But you're extrapolating the data, you're not applying the data. And I think that's where people hear about transactions, because we don't know what the EBITDA was, we don't know what the profitability was, we just know we just know what the data, what's occurred, and then we work the numbers backwards. And in the end, it's an extrapolation. And
I get that.
On that.
So is there I'm sure the answer is no, but how about, is there a majority of the time a blueprint that these deals are done on, right? You know, like, or is it so different deal to deal to deal?
Well, there's a couple things. So like when we do a valuation on the business, let's just take, what do you want to take as a standard firm? Let's just say 5 million in revenue. And
sure, let's go.
That 10% EBITDA, so that's 500,000 EBITDA, $5 million firm, right? And so at that situation, you know, if we were to do a valuation, let's just keep the math simple. At a 5x multiple, that would mean your valuation would come in somewhere around $2.5 million, right? Now, if you really had 500,000 in EBITDA, I'd say you might be closer to 6x multiple, but you know, I want to keep, for everybody tracking things, let's keep the math as simple as we can. So if we had a 5x multiple, then the value of the business would come in right around $2.5 million. Okay. Now, if you looked at that, and if I'm coming as a buyer, well, I'm not paying all cash. I probably have, most transactions have part of it cash, part of it, 93% of all transactions have some form of earnout or deferred payment based upon performance to make sure everything happens. And so it's not uncommon for a transaction that's $2.5 million to be, say, hey, maybe you know, maybe $1.5 million in cash, and maybe another $500,000 in a seller note and $500,000 in earnout, right? Or some other piece. If you really got an all cash offer, I'd be shocked if you got an all cash offer on that business for, you know, more than about 1.5, 1.8 million, because it's
so if you want all your money up front, you're going to take a discount on your offer, on your deal. 30 to 40% discount for being all but that's because the buyer has all the risk now. They've got to make sure that they don't lose any customers. They got to make sure none of your employees leave over it. You've disappeared and gone off to, you know, sail around the world, if that's your aspiration. And so as a result, they inherently have all the risk. Now, conversely, if you're other extreme, you were to take it in an all or not, hey, you actually might get a $5 million transaction value, but you got to be around for the next 5 years, and they're going to pay you based upon your performance. And if you're doing the math on that, you're going, well, if I did that, that's the same thing as running my own business for the next 5 years, right? And so most people don't do that, but in the end, you could get this $5 million value through all being earned out. And so that's the difference between transactions and valuations, is in the end, the terms of the deal are going to swing the value of the business more so than the valuation. The valuation is going to come in and kind of say, hey, here's what the number is based upon a series of assumptions, really around the perspective of an investment perspective. And a transaction is going to have all the synergies, cross-selling, upselling. And so we do see some pretty phenomenal things out there. For example, I have a good friend of mine, sold his business. I wasn't a part of it, but he sold his business, 1.1 million in EBITDA, and he got $11 million. He got a 10x multiple. What kind of business was that?
It was a managed services firm, and it was a pretty standard, regular MSP. The reality was the buyer definitely wanted to be there. So it was in a hot location. The buyer wanted to be there. The buyer had a bunch of customers there. We just needed a platform to be local, to be able to do this. They had a bunch of initiatives going on. So for the buyer, great return on investment. The buyer still got a better than 20% return. In other words, you do the math on that, that's a 5x multiple. From the buyer's mind, I get my money that fast, but that's because of all the opportunity, the synergies, the strategies of the business. As a result, the buyer still got a great rate of return, seller got a really good multiple, and in the end, both are happy, right? And so
but you would say that that person overpaid based on the current market conditions.
They overpaid on the current market conditions, but their rate of return was the same. So when you think about rate of returns, and I don't want to get, this is obviously into a bunch of weeds, but this is how fast can I get my money back? So for them,
Time is money.
time is money. So for them, they looked at it and they said, look, we're going to get all 10 million of that back within 5 years, because we're going to have a presence here that we couldn't get this business. We couldn't deliver this business without this company being here. But now that we bought this business, we're able to successfully do that. So a 5-year return, when you or a 20% return on investment, that's the same thing, is the same thing as a 5x multiple. Did they pay 5x? No, but their return rate gave them the equivalent of that. And the seller was able to harvest a way higher than average multiple on the business. And so a lot of that stuff, the hard thing there is coming back to your question about, average businesses and average multiples. The problem is everybody feels themselves about that they're better than average. And if you would know who that company was, you'd be like, dang, I'm just as good, every bit as good as them. Why can't I get a 10x multiple? Well, because you have to have a buyer who has that unique situation, that has those synergies, those consolidations, that kind of market opportunity to be able to get the same thing. And the result is although it's in the analysis of what multiples are trading for today, is not a fair comparison, because in the end, it took a willing buyer and a willing seller with a unique set of motivations to be able to get to that unique price.
So basically what you're saying is, like a Super Bowl, stars have to align and you have to get a little bit lucky at times, right?
Yes.
So a couple of people popped in already. So we have our buddy Keith out in California saying, and I was about to ask a question, well, if MSPs are all kind of doing things largely the same way, what makes one different other than people process, right? That kind of thing. He says, what about factoring in if you have your own intellectual property, right? Let's say you build software as a part of your technology business, right? That does change things now.
It definitely does. And so intellectual property has a huge impact on that. And so, but here's the thing, intellectual property has to be different, right? If it's true intellectual property. So one of the things most companies don't realize is how much intellectual property they actually have. And so there's a lot of buyers that go around. And so when we talk about intellectual property, a lot of people think, well, you have some sort of product that you're selling on, the Microsoft partner or the Google, marketplace or something like that. And we're not looking at that level of complexity, although if you have it, it's immensely valuable. But it really is. If you, for example, and we see this with companies who have verticalized. So we have a client that's a former client that's really focused on the legal space, 5 to 50 person law firm space. They've built out a specific way of onboarding. They've built out a specific set of tools. They're able to get their typical per user rates about $250 a user for the package that they built for that space. They have a bunch of intellectual property as a result of it. And the result of that is, yes, they're going to trade for much closer to that 10 times EBITDA type number. But that's because you're able to take that, and a private equity company could come back and say, look, you're doing it really great in New York, and you're doing it great in Florida, but we can take that program and sell it nationwide, and we can radically accelerate the growth rate. So their return on investment comes back to all I want to be really clear. All buyers calculate return on investment for all that. So they can pay to the buyer. It's not about the multiple, it's about the rate of return. And private equity has this figured out that says, hey, if I can scale this thing faster than you can scale this thing, and I'm the one that's able to harvest the growth on it and then turn around and flip it and sell it for more, hey, I get to my same level of return, but I'm able to pay a premium price.
Now, so the answer is, if you can build something unique, right, that can, they'll attach a value differently to that part than the rest of your services business, right?
So, and we talk about that in the context of monopoly control. So if somebody can buy your same set of service from a firm two blocks away, you have no differentiation, and it's all going to be about the price, right? And so the more differentiated you are, and so when we talk about differentiation, there's multiple ways to layer it. So let me just touch on that. Obviously, you can talk about differentiate in customer satisfaction. Hey, I can show you to a new customer that my customer satisfaction scores are 98%. So I have a 98% customer satisfaction. We see some of the stuff that gets put on people's websites. We have a certain ticket response time. We handle so many tickets. That is creating differentiation from somebody who can't produce that. But there's other levels of differentiation. And again, I really love the verticalization because, for example, we had a client in Sarasota, Florida, who's really ended up being about 25% focused on the healthcare market. They're a typical MSP. And so when you look at, they wanted to expand into Tampa Bay. And so really close, hey, makes good sense. Okay, if you go to Tampa Bay as an average managed service provider, guess what? There's 82 managed service providers in Tampa Bay that look just like them. How different are you? You're not. And so somebody's going to go, well, are you local? Well, no, I'm just down the road though. Really hard sell. If they focused on that healthcare IT space, which they had a great story around, guess what? Rather than having 82 competitors in Tampa Bay, they only had 2 competitors in Tampa Bay. In fact, if you looked at it, they only had 8 real competitors in all of the state of Florida if they went to market as the healthcare IT service provider, right? And so when you look at that verticalization strategy, a couple things happen. Not only are you able to package your services, and coming back to the legal market, one 5-person legal market, company to another 5-person legal company, almost identical. With one server, handful of mailboxes, handful of servers, there's just really limited differentiation between. So you're able to create a very high product. Anybody in the legal market says, wow, everything they do is law firms. So your onboard rate is way faster, way shorter. You're going to get a premium on your value. You're going to be able to charge premium rates, and you're going to radically reduce your competitive threat. And so in the end, when you look at verticalizing into a market, and we're not saying even the whole market, but just saying, hey, is it the SMB space? Is it the mid-market? Is the enterprise level? Because the service offerings that you're going to provide each of those classes are different. Once you have it, you have just an optimum value business. A lot of people really wrestle with that. So we have another client of ours that's focused on the hospitality space. Now, you would have thought that the hospitality space got like beat the heck during COVID. They grew 30% through 2020 and 28% in 2021. Why? Because hotels don't go out of business. They get bought and sold. And every hotel still needs managed services. And so they built their whole program around hospitality and hotels. They did phenomenally well. And they're going to be able to be at a place because of their intellectual property that they have built for the hospitality space and how they play in that space. They're going to be able to get, probably twice the value of a typical MSP.
Wow. Surprised to hear hospitality
Yeah.
made it out okay during that time. So a couple comments.
The industry didn't, but they did really well through it, right? So that's an important thing to recognize, especially if you're in IT. A lot of them are like, well, and another client that's in the dental space, and you're like, oh my gosh, they got beat. Guess what? Every dentist still needed all of their infrastructure managed services still running. They couldn't shut it off because the little amount of work they did, they still had to be there, still had to do that. And again, they did really well through COVID in spite of the fact that their industry took a beating.
Okay, let's throw a couple pieces in here. So Pete says, hey, if you plan to exit, maybe you should consider doing an evaluation now, even if you're not ready. And then 2, 3, 4 years in advance, you're just doing updates annually as you get closer towards making a decision on when's the time.
Yeah, well, a couple things on that. Pete's definitely right. So what most sellers don't realize, it's going to take you 3 years to get ready to sell. Most people don't run their business ready to sell. And so when you have that valuation done, and once again, there's a lot of people, there's people that can do it. We're probably the only certified valuation analyst for IT services firms. So we verticalized, we eat our own dog food on that, or drink our own champagne, depending on what part of the country you come from. Anyways, the point on that is you'll have really good clarity on what needs to change within my business so I can drive that value up over time frame and over time. And it is something that you do need to adjust. You need to look at. We, unfortunately, too often we get sellers who are tired and they're like, hey, I've been doing this for a long time. I just need to get out. And by the time you're at that point of fatigue, you're not in a position to be able to really optimize the value of your firm. And so a lot goes into it. But I would just say, and George, one of the things that we had, great conversation 4 years ago about is it's more than just selling a property. This is oftentimes your identity. You've put your blood, sweat, and tears into this thing. You've made sacrifices. You've missed your kids, football games sometimes to get there. And a lot of people think, oh, I just want to be done. And there's so much more, not only from getting.
That's a bad position when you're ready to
Yes.
do something, is what you're saying.
Yes.
You
Well,
need to probably hang in there for a little while before you're actually ready to do something.
right. And you need to really view this as a stepping stone into what I do next, right? So again, we have sellers that come to us, say, hey, I want to sell it, even if their business is in a good spot for the transaction. I would say literally 90% of the time we're in the middle of a transaction, usually about 4 weeks, 3 weeks before close. The seller has this moment of reality that says, in 3 weeks, I'm getting a check, and in 3 weeks, I'm not showing up to work again. And who am I without my business? I don't know who Reed is without IT Valuations, because I am that, right? What's BVoIP without George Bardisi, And so all of a sudden you have this emotional kind of crisis that occurs because your identity is found in what you're doing. And your business.
I just figure I'll end up going to more Eagles games, Reed.
Well, there you go.
There you
Better
go.
than Vikings games, because we're still not there. So
well, you just got a coach. Now you need everything else. So our friend Keith may need your help. I may have to connect you guys after this,
Okay.
but he said, here's my question. If I want to retire and live in the lap of luxury like George,
yeah.
should I market my IP separately, or should I package it with my services business?
Package it with your services business, without a doubt. So one of the things that creates a whole lot of value, the reason for that is this: it makes it really, really hard for somebody to come in and basically reproduce that IP, right? So when you build your IP and then you do edge services around it and you sell it as a complete solution, a couple things happen. You're able to drive up the rates to the end customer. It's really hard now to figure out what's IP and what's the service piece. And so the whole thing becomes much more of an IP situation. So definitely, I would not call it out. If you call it out and actually productize it, no offense to India and China and other places around the world, but now it becomes really easy to reverse engineer and somebody else to come out with a copy of it. So when you take that same IP and you put your own services around it, it becomes really hard to figure out exactly where the IP ends and where the service begins. As a result of that, you're going to get a greater value because of the services that you've wrapped around your own intellectual property.
Keith, this was recorded. Go back and rewind, my friend. And then when you're done doing that, I'll connect you with Reed. So we're gonna probably do more than this one session because there's just so much there. Obviously, without giving names, right? Kind of anonymize this. You've been in the middle of helping broker what should be a successful outcome, hopefully,
Yeah.
many times. There's probably been a lot of situations where you turned into the bad guy, right? Just because the left side and the right side couldn't get along and you had to figure out how to get it to the end, right? What are some of the things that, can you give us a couple of examples of where things, seemed to be very difficult and there was a disagreement that's just seemingly couldn't be resolved? What are the examples of that? Is it, disagreements over percentages? Is it different disagreement over, who gets which side? Maybe there's, I think there's a couple of examples we talked about in the past where maybe there's partners, right? And there's an even split in the business. It's a little bit harder to figure out who's in the driver's position. Give us a couple of examples of things that, hopefully as a lesson to everyone else on what not to do, of where things could go wildly wrong.
Well, again, so looking at transactions holistically. So one of the things when we represent a seller, we want to engage as early as possible, because actually those early stages is where you have the greatest ability to impact value, set your price at a right level, and really set the expectations for what a buyer's going to experience as they go through the transaction process. And so here's where I would say the number one reason why deals fall apart. And this comes back to, George, your conversation about average. Nobody views their business as average, right? And so we all are pretty much wired to put the best foot forward. And so what we see happening, and this is part of a buyer's strategy, particularly, I don't want to beat up private equity, but it happens most often in private equity. So we're going to have this saying, George, you're interested in selling business. On the buyer. I'm going, hey, dang, this is really good. Really like what you built here. Tell me more about it. And George is like, well, last year was a $4.7 million firm, but talking to George, well, this year we're going to crush it. It's going to be $6 million. And you're like, yeah, okay. And then, how are you doing profitability wise, George? And George goes, well, it was 11% EBITDA, but I can round that up to 15% because I want them to be really impressed with my business, right? And so it's not like gross misrepresentation. It's just kind of the rounding up. So me as a buyer, I'm going, great. So this is a $6 million firm and it's 15% EBITDA. And I go, okay, great. Well, I'm willing to pay, a certain multiple on that based upon the stuff. And so, how's your operations? George's like, hey, really good, but what George didn't tell me was, hey, today his number one, his tier 3 guy that's been around for 7 years just got an offer from Microsoft and is going to Microsoft because he's got 100% pay raise. George doesn't want to talk about that because he doesn't want anybody to be concerned about it. And so doesn't talk about that, doesn't let the buyer know that. And so we put together an offer. So as what a lot of buyers will do is they're going to take all that stuff kind of in good faith, not really challenge it, not ask for stuff. We'll strike a letter of intent. And now we do due diligence. So before the letter of intent, everything is done in good faith, that what you said is actually the truth. And guess what due diligence is all about? It's taking good faith and putting it into good fact. And so now we're going to actually go through the numbers. And then I'm going to go, George, but you told me you were $6 million. And George, you're only 4.8. And you're like, yeah, I know, but we're really growing really well. Yeah, but that 10% EBITDA, that was 11. You said 15. And so now I'm really concerned because you didn't really tell me the full truth. And I'm finding that things aren't that great. And you told me you had this great team, but your top guy just left. And how much the other team's going to, leave over it. Right. And so what happens with that, for most buyers, now I got to retrade the deal because you just didn't tell me the whole truth. And all of a sudden the seller's going, what? I mean, I might have stretched a little bit, but I wasn't like really lying about anything. And so that's where so much of the transaction deal falls apart, is because they find these things in due diligence. And so when we come with sellers and we help them prepare, it's like, hey, you got to know your numbers well. You've got to say, hey, we're going to be in 11%. We're at 4.8. As a result, this is our profit. Here's where we're going. And what happens when you actually are transparent beforehand, and then they move into due diligence and they find everything was right that you said about the business. I actually don't dig as deep on due diligence because you've proven the fact that you've told the truth through the whole journey. And so your best advantage on it is to just be really transparent. Here's where things are actually at. Here's where things are really growing. And when you say, hey, we're going to hit 6%, 6 million. Okay, tell me about that. Because that sounds really, obviously you got something going, and you can say, hey, we have these contracts, we have these things. This is why we're going to hit 6 million at the end of 2022. Now, as a buyer, I'm starting to raise my value from what it was rather than going, you lied to me, right? And so that's where really the number one reason why transactions fall apart is when we get to due diligence. The seller fundamentally has misrepresented the data there, and now it becomes really concerning. And again,
I wonder how often that happens on Shark Tank.
I love so. If I could tell you one thing, I wish every one of our sellers actually would sit and watch 3 or 4 episodes before taking themselves to market. Because, well, I actually don't like watching the show because it just gives me, it gives me whiplash for so many of the deals that we get a part of, where somebody's like, hey, I got this great idea. Is it making money? No, but I think it's worth $5 million. There's
I love when Mr. Wonderful comes out. He's like, so you just made up a number? There's nothing to back this value of your company, right?
Right. And there are times where you just, so I was on a call yesterday where somebody had just a real inflated value. And you're just like, there's just no way. And I hate to be the bearer of bad tidings, but I almost wanted to quote, Mr. Wonderful say, I should crush you like the cockroach you are, because it just, I love, and that's so politically incorrect and so rude, but there's just times where the expectations are so far out of alignment with reality. And so really helping, whether it's us or somebody else, having that valuation done ahead of time, just to really get a good expectation. Okay, here's where it is. We do have valuations that are typically about $5,500, $5,750 to be exact. We do have an estimate of value for the sub kind of $2 million marketplace, where we really look at the kind of the balance sheet and we figure out what that value would be. It's worth doing just to help manage expectations. And I would just say, most people don't realize that, because we tend to believe ourselves better than average as a human being. It's good to have the dose of reality before you take it to market. And now you know what you need to do to work on. And so that you can actually, so much of what we do when we represent sellers is not that we change the data or we do things, but we do go through this exercise of saying, hey, here's some things we need to fix. And if we fix these things, it now tells a different story. And as a result of being able to tell a different story, we're able to position you well for a value that's actually really there, rather than coming at it and saying, well, I just think I'm worth a lot, right? Because every buyer goes, yeah, everybody thinks they're worth more than they really are. But you need to have the story put together. And I say story, not so much a narrative, but it needs to be reflected in the financials. And so being able to put, because in the end, for most buyers, the proof's in the pudding, and the pudding is your financials. If your financials are a mess, then I can't make heads or tails of whether you're telling the truth or not. So getting all that stuff put together ahead of time, it's not so much that it changes the numbers that you presented, but now somebody can see it in the numbers. They go, okay, this thing, it really is a diamond in the rough.
The numbers drive everything, clearly. Pete comes in and says, what combination of EBITDA and revenue do you want to drive to get a good valuation? Well,
40.
40.
The answer is 40. So how do we do that? You can Google it, look up rule of 40. I think Harvard Business School is one that first developed that whole analysis. I use it pretty much in about every conversation that I have with an IT services company. So here's how it works. Take your EBITDA as a percentage of revenue. So let's say you're 15% EBITDA. Okay, that's one number, 15. What's your growth rate year over year? Well, if I'm growing at 10%, that's 10. So I go 15 plus 10 is 25. Optimal firms that have it dialed in, will be between a factor of 35 and 40. What does that translate back to? Top quartile firms are doing 20 to 25% year over year growth at 15 to 20% EBITDA. And so when you put those together, you're at 40, you're between 35 and 40. So I do have a lot of companies that come to me and say, hey, I'm investing in growth. I'm putting all my profits back into growth. That's why my EBITDA sucks. And you're like, okay, then you better be growing at 40%, because if you have 40% growth rate and 0% EBITDA, guess what? You're at a rule of 40. But if you're at 15% growth and 0% EBITDA, I'm like, yeah, you're not a top quartile firm.
Okay, so let me take a wrinkle to what you just said. A lot of people accrue debt, right?
Yeah.
They borrow money instead of taking their own money to grow their companies.
Good
So a lot of people, in some cases, I assume, they'll sell their book of business, but not the company, right? They're gonna, they're not passing their debt along to the buyer with all of the rest of the legacy, corporate, pieces. They're literally taking their contracts, their customer base, and saying, here, I'm selling the book of business. How does that differ from what you're talking about?
So I'm going to separate that, because that's different than the rule of 40. So rule of 40 is really helping us understand. I know Paul Dibble talks a lot about OML, operational maturity level. I use the rule of 40 as an operational maturity index. It's not coined that way, but when somebody comes to me and they says, I'm running a good firm. If you're between 35 and 40, I know that you're running the top quartile firm, right? And I don't really care what the balance is between growth and profitability. Because in the end, if you're operating between 35 and 40, it tells me you have control over profit and growth. So now you're making decisions of going, hey, we have this opportunity to capture market share. My typical growth rate's been, let's say I'm doing a 20-20. So I'm 20% growth rate, 20% EBITDA. I'm at the rule of 40 really nicely, but now I have this opportunity to capture market. Well, great. So I'm going to push my growth rate up to 30-35%. Correspondingly, I'm expecting to be operating in that 5 to maybe 10% EBITDA as a balance to it. So the nice thing about the rule of 40 is it gives you this flexibility to say, regardless of what your revenue is or your growth is, and regardless of what your profit is, when I put the two together, they're always going to be staying in this nice balance. And so only 2% of firms can sustain being over 40 for more than 5 years. So if you're at a company and you look at it and go, hey, I've been able to, and I have some clients that are doing that, but you're just in the top 2%, you're in some pretty rare air. and you're going to get a really premium multiple as a result.
Okay, before you switch to the other side, what happens if they were on track and then 2020 happened?
Yeah.
They dropped to single digit growth and then they're back on track after 2020.
Yeah, and some of that's just going to be coming back to the narrative, right? When we say, because you do have this event that hit everybody, and it's called COVID, and that threw a big wrinkle in things. And so part of the reason why we're seeing more sellers today coming out of the market, coming back into the marketplace, is because I'm able to show that I'm back on that trajectory, right? That says, hey, we were on this piece. I realize, and it's never truly a straight line. There's always ebbs and flows on that. But the point is this: you do have a great story around COVID to say, if I had a dip, blame it on COVID. But now that we're past it, I'm back on that same trajectory and on that same.
Does that work?
And it works.
Okay. See that, Keith? You'll be all right, buddy. All right. So now we're back to the book of business. Different story, right?
Yeah. So books of business are really hard to sell by themselves, but mostly what you're going to see there is an asset purchase. So typically in that case, I'm going to buy the asset, which is the book of business. I'm going to buy the employees out of it. In the end, I'm not buying the debt. I'm not buying those things. And again, this is where private equity really has it figured out, and not to share their playbook, but in the end, they're borrowing money. There's a lot of places you can borrow money. You can borrow up to 4 times, your EBITDA as a part of it. So you're looking at it going, well, 4 times doesn't give me an 8, right? But allows you to be able to buy the cash portion of the business. So we're coming back to the conversation on the leverage you pull in it. Part of it's going to be cash. Part of it's going to be seller financing. Part of it could be equity or some sort of earnout, right? So in the end, I'm borrowing.
That's why they break it up into pieces, because they may not have all the money, or they may not want to spend all the money all at once.
Exactly. So it's how do I leverage that? How do I leverage that cash, right? That I'm borrowing at a really good. So I'm borrowing money at a 5% interest rate as an example. And now I'm going to take that and I'm going to now buy you. I'm going to buy you. So let's say at a 5 or 6x multiple, I'm only going to be really using 30 to 40% cash to do that. And the result of it, I buy you into my firm now. And as a result, I went from a 6x multiple to an 8x multiple. If I buy another one of you leveraging the other half of that cash, I'm at a 10x multiple. Now what I'm doing is, hey, I'm going to sell my firm at a 10x multiple. I paid each of you guys 6. As a result, me as the buyer is going to walk away with that 4 turns higher in total value. And I'm paying off the debt that I borrowed at basically a 1x multiple, right? And so in the end, it's all about leveraging debt. And so even on the private equity companies on that, they are borrowing money separate from their investors to help offset the cost of capital. And they're looking at bolting together, firms. And so when you look at your typical, if you're 1 million in EBITDA, you're probably at a 6, for simplicity, say a 6x multiple on that. But if I'm 5 million in EBITDA, I'm probably at a 10 to 12x multiple today, right? So if I buy 5 companies at $1 million in EBITDA and I pay 6x multiple, and now I'm going to turn around and sell that whole portfolio at a 10 to 12x multiple, I as the buyer am harvesting that differential.
So that's why it makes sense, or that's why when you stack people together, right? If you go into your peer group or you go into a group of people at a trade show and you just say, I'm going to rubber band 4 or 5 or 6 of you together, as a group, you're worth more, because once you get to a certain dollar amount, the multiple goes up.
Correct. And that's predominantly because there's so few 5 million in EBITDA MSPs out there for sale. And so I see it, and that's really what's driving the merger conversations that we're having. So let's just touch on that real quickly, if I could. It's all about, for everybody, you have to have an exit plan. Once you hit that number, you need to execute to that number, because there's just a lot of risk in the marketplace. You're always one ransomware attack away from being either out of business or 60% less in value, right? And so there's just risk out there associated with it. So having that number for what it is that I've got to exit, simple math on that is going to say, hey, what's the lifestyle I want to have? If I have a $200,000 lifestyle, I want to live on $200,000 a year. That means you need $4 million. You need to sell, so 20 times. So 20 times whatever your lifestyle is the amount after tax that you need to get for selling your business. So if I need 4 million bucks and I'm at a 40% tax bracket, I need to actually sell my business for somewhere around 7.5 million bucks. So I can walk away with 4 million, so I can support my $200,000 lifestyle, right? So that's the number. So now it's like, well, my business isn't worth 7.5 million. My business may be worth 5 million, right? So in that situation, you're going to look at it and say, how much time do I have left? I can keep organically growing. That's going to be the lowest risk option to get there. But if I'm 64 and I want to retire in a year, well, I don't have that much time to get to $7.5 million value, right? So now how do I get there? There's a couple of ways. So you could merge, and that's going to be the next least risk option. So if I merge with another company and we go from a 6x multiple to an 8x multiple, and we have the same idea that, hey, we're going to sell this thing in 2 years, we're going to integrate and then sell this thing, and we move from a 6 to an 8x multiple. Well, now if I had $1 million in EBITDA and I went to an 8x multiple, well, guess what? I'm at 8 million bucks. So if we sell, I'm at my exit number, I can walk away, I can do that, right? And so that, that's the next horizon on that, is to do a merger. The other way is to do it through accelerating your growth through acquisitions yourself. That's probably the highest risk option. It's also going to be where you get the highest return on your investment. So, but understand that if you're going to do acquisitions, you need to have a longer strategy than a 2-year strategy. You're probably going to be in for 5 to 7 years, because it's going to take you that long, not only do the integration and merge, but then to clean up the financials and the books sufficiently so that you're able to completely harvest that. So again, if you're trying to get to that $10 million number rather than the 7.5, in that scenario, well, then you're probably going to be better off doing the acquisitions and growing through acquisitions to be able to get to that $10 million value, certainly within the next 5 years.
10 million is the magic number for a lot of people, right? In terms of what the best possible multiple. That's when like things really open up after 10 million and above, right? Well, but so few MSPs actually get there.
Yeah, it's really more on the EBITDA side of things than the top line revenue. Although I would say from a value perspective, from a demand perspective, yeah, if you're 10 million in revenue and 10% EBITDA, that's $1 million in EBITDA. I, as a buyer, will look at it and say, great, I can pay you a 6x multiple, and I know, because I'm running at 20% EBITDA, I don't even have to grow you. In 12 to 18 months, you're going to be running 20% because I run 20%. Right. And guess what? As the buyer, I'm the guy who gets to harvest the value of that transformation in your bottom line. The fastest way to transform your value is to transform your EBITDA. And so I want to stop on that just real quickly, because a lot of people go, well, I'm just going to add back stuff and I can get my EBITDA. Everything you add back becomes a negotiable item for the buyer to say, is it real or not real? So some things you can legitimately add back, right? So if if your spouse is not working in the business, but you pay her a salary, yep, I get it. That's an add back. Nobody's going to complain. When you say, well, I did $10,000 of trips last year, that were really just kind of personal. Guess what? You're not getting $10,000 in the add backs, because some of those were to ConnectWise, but you stayed an extra week. So part of it was, I was at ConnectWise, part of it was personal, right? And so with all of those things, it's really important that the highest value firms are going to be ones that really don't run things to your business. And here's, I had a client that was interested in selling his business. He talked to the buyer, who's running about, they're about 500,000 EBITDA. He was running about 300,000 through the business, and he tried to collect all that. And the buyer said, look, I'll talk to you when you run your business like a real business. And at first he was really pissed off about that. And he's like, hey, this is 300,000. I'm doing this so I don't have to pay quite so much in tax. But here's the thing. He was saving 30% on that 300,000 when he could have been getting 6 times that 300,000. So which was more valuable, saving the 30%? Or just not putting that 300,000 through the business, improving his bottom line by 300,000, and now he could have gotten 6x on that 300,000. That's 1.8 million, right? And he learned that lesson and just said, hey, it is better for me. I know I'm going to go out for a steak dinner and it's going to be a $200 dinner, rather than running that through the business. Hey, that's not a $200 expense. That's actually a $1,200 expense. Would I pay $1,200 for that dinner? No, I'm not running it through the business then. And as a result, he was able to transform his bottom line. In the end, he was much happier for that, even though he's not saving as much in tax.
How long did it take that guy to clean it up, though? 2 years, 3 years?
It took him 2 years. So it did take him, well, it took him about 14 months to actually do that. But the point on that is when you go to sell your business, the less you run through the business, the better the multiple you're going to be, the cleaner your books are going to be, and the easier it is for the buyer to be able to see your story in the numbers, because the numbers directly reflect the business.
Keith Nelson says, what about cars, boats, and vacation homes? I assume those all apply.
Yes.
You probably want to not keep those on your company's books. Quick, and cigars. Well, we know that for a fact. Quick rapid fire, since we're getting towards the end of our time. But 3-year contracts versus month-to-month contracts, does it make a difference?
Yes and yes. So, but let me explain it, because it's not the way people do. So when it comes to selling the business, yes, having 3-year contracts will get you more value, right? Because it's, in the end, what drives value is what's sustainable and transferable. So the longer the contract you have with assignability, it has greater value, because I now know I'm going to get that revenue for the next 3 years. And if I can assign it, I know you can transfer that value to me as the buyer. So yes, having a 3-year terms is going to be more valuable than having a 1-year term or a month-to-month evergreen. Here's where I'm going to counter that very same statement. If you're creating value, go with the 1 year and the 1 month out. And here's why. Because people or end customers are going to take 3 to 4 times as long to make a decision about whether to sign a 3-year contract. So your ability to grow, so coming back to that rule of 40, you will grow way faster having a shorter contract with a 30-day out, because in the end, the buyer's going to go, well, if I don't really like you, I can be out in 30 days. The reality is once they're engaged with you, the pain to change is too great. They're not leaving you unless you really screw up, regardless of how long your contract is. And most of the time, even if you have a 3-year contract, usually you're not going to sue your client if they decide to leave you, right? So in the end, the contract is nice to have. So where you can get it and when you can get it, get long contracts. But I'm going to say, don't do that at the expense of growth, because if you're able to grow 10% faster as a result of having a shorter contract, you will create more value quicker through having a better growth rate than through having longer contracts.
Does subscription-based revenue, even if it's products, get factored the same way as labor or not?
Yeah, good question. So we treat it as recurring revenue because as pretty much the same. I know Paul Dipple breaks out different multiples on that, and there's truth to that. So I don't want to undervalue what he's saying. But in the end, what I am looking for in a transaction is transferability. So the more customers and or product that are on a reoccurring nature that have assignable, that have a contract that is assignable, the more valuable the business is. Because in the end, if they're on that, that's so when we structure deals on the sell side, we're actually looking at the transferability of the recurring revenue. In the end, most people aren't selling projects to companies that aren't recurring customers, and not selling products to other companies, to their customers that aren't recurring customers. So in the end, if I get your recurring customers, I get the rest of your business. And so I would just say there is, depending on the buyer, there could be some differences in value, but I would say for the most part, it's pretty minimal. What we want is recurring revenue, and the higher that is, the better it is.
So does the percentage of recurring revenue versus one-time revenue play a factor? Meaning, if I show on my books that I don't sell a single piece of hardware as a resale, and I just direct them to Amazon so that my books just show recurring revenue, does that help me in that case, or does it matter?
Yeah, it does help you. Typically your multiples will be higher because the buyer's looking at it and saying, hey, I'm getting those things. Product is probably the least valuable asset you're going to basically sell. So seeing somebody with high product sales, in the end, what fundamentally drives value, and I want to make sure you guys hear this out, and that is the value of your business is what's sustainable and transferable, right? So transferability has everything to do with contracts. So if you're doing a lot of projects and a lot of product work, I can't assure that that's going to be sustainable because you got to go sell it every time. And it's not really transferable because the only thing that's going to transfer is the projects you're currently working on, right? So the more of your business that is sustainable and transferable to the buyer, the greater the value of your business is. And so it's really, and so we do work on some of the strategy sides with clients that have a lot of product sales and project work. I've got a number of clients that I really have learned that I can take that same project work and I can build it into a service level agreement and turn it into reoccurring revenue. And so I've got clients that are Microsoft ERP implementers who have actually, hey, I've got clients that have been on for 10 years, and every 3 years they do this big lift and we do a bunch of projects kind of in between. And they've gone back to their customers and said, look, you keep going through this big lift and the same thing. We're just going to level set that whole thing, and you're just going to pay X amount a month. And it's going to be really steady. And we're going to do the big lift every 3 years. And you're going to get all this other project that you've been paying for. But we're just changing the structure of how you pay for it. And we're turning it into a service level agreement. The result is, this comes back to some of the stuff that Paul Dipple talks about. I just went from a 0.7 times project work to a 1.4 times recurring revenue. My value basically doubled by going through that process and turning project-based work into service level agreements. And you can do that for implementations. You can even do that with products. And one of the things, not necessarily a big fan of Haas, but you can certainly put hardware as a service into it, because as soon as you do that, people are programmed to go, oh, I got to sign a 3-year contract. So now you're not fighting the battle of the month and out. If I layer in some product and a hardware as a service, and I package this, let's get intellectual property. So I package some hardware as a service, I'm packaging some software in there, I'm packaging my services around it, and the customer is getting it for $225 per user per month. And now I'm going to get a 3-year contract on it because there's hardware in there. And so now I can't rip the hardware out without doing that. And so for the customer's like, well, there's hardware, I got to sign a 3-year contract, so you got to be able to protect that. Now I have a long contract. Now I've converted my project and my product into that service level agreement, and I've transformed the value of my business almost, well, as quickly as you can do that. I would say overnight, but you can't really do that overnight. It takes, a good 6 months to a year to actually be able to transform that way you sell to your customer.
There's way more here, guys. Like, we went really surface level of the iceberg. Okay. So we're going to bring Reed back. Don't worry. But in the meantime, for people like Keith Nelson, how do they find you, Reed? How do they connect with you?
Reed at itvaluations.com. And you can go to our website. It's VALATIONS. So ITVAL. I better. No, see, I can look at numbers, but I can't spell. No, it's itvaluations.com, S at the end of that. So you can look us up.
So there's more stories coming, trust me, and they're good. And we'll get into scenarios, not maybe as black and white as we talked about today, because life is gray a lot of the times.
Yes.
So definitely, circle back. We're going to have Reed on, shortly, not next week, right? Because we're going to be in Florida. We'll still be online, but we'll bring Reed back now, pretty soon into March, I think. So keep your schedule open there, Reed. And for everyone else, MSPinitiative.com under sessions. And if you want to go back and look at the series from 2018 and 19 that we talked about earlier in the session, that's actually on the BVoIP website, bvoip.com/videos. And you'll see all of the sessions we did with Jameson West and with Arlen Sorensen, and it was actually a pretty good series. But hey, listen, things evolve, things change, and here we are in 2022. We're going to talk about 2022 moving forward. Thanks everybody for jumping on. Reed, talk soon. Everyone else, hopefully we'll catch you in Florida. If not, right here again, Tuesdays and Thursdays, 1:00 Eastern time, and online 24 hours a day, 7 days a week. Catch you guys later, guys.
Thanks.